What are the determinants of the demand for foreign exchange? I want you to think of any generic demand function and ask, what do the determinants of demand look like? I'm giving you two examples here. One which says the quantity demanded of a particular good will be a function of the price of that good, the price of substitutes, the price of complements, the income of the individuals purchasing the product, advertising, etc. A second specification is offered where instead of income and advertising, I've substituted demographic and geographic and climatic variables to tell you that if you have a cross-sectional analysis, you might be able to see what is happening in different regions and different population groups and under different climatic conditions. For example, rainy days versus sunny days, or winter versus summer, etc. It is always important to ask, who are the individuals or the institutions doing the demanding? In the case of foreign exchange, it is those locals who want foreign products or foreign services, or those who want foreign assets or foreign investments. They want these things that are in other countries. Either they want these things to be brought to their country so they can consume them, or they want to move their monies so they can invest elsewhere. So these are the people who want or demand foreign exchange. It is their behavior we consider when we build the demand function. On the goods and services side, those wanting foreign goods and services will generally influence the demand for imports, and this activity will be captured in the current account of the balance of payments, while those wanting foreign assets and foreign investments will generally influence the demand for foreign investments, and this behavior will be captured in the capital and financial account. On the supply side, we ask the same question: what determines the supply of foreign exchange? Here we see that there's a positively sloped supply curve. And before I go any further, I should mention that E, the variable on the vertical axis, is the price of foreign exchange. You treat it just like you would treat the price of any product you would purchase, for example, the price of a pair of shoes. If you don't treat it this way, then your demand curve will be positively sloped and your supply curve will be negatively sloped. So make sure you understand why it's important to define the exchange rate as the price of foreign currency. So you choose a country in which to be located and determine the price of the other country's currency, the price of foreign exchange. So what determines the supply of foreign currency? We may start as we did with the demand function by asking, what might the determinants of supply of anything look like? And I've said in the past that the supply curve is more of an ideal construct than the demand curve or the demand function. So we draw this positively sloped supply curve, but there is no good reason why the supply curve will be positive unless we inform the sketching of the curve by talking about increasing opportunity costs, and that is what makes the supply curve positively sloped. My favorite analysis to convey the idea of the supply curve, though, happens to be the labor supply curve. And here we are asking, if your employer pays you a higher hourly wage, what will you do with your supply of hours? Will you increase the number of hours you offer the employer? Will you keep it at the same level? Or will you reduce the number of hours you offer? The answers depend on your own utility function. If you keep the number of hours the same, then you have a vertical labor supply curve, and we are saying that your quantity of labor supplied does not vary with the wage rate. If you supply more hours in response to the higher wage rate, then this will be shown by a positively sloped supply curve, and this is the more traditional analysis, but we have to ask, how many hours are you already supplying that you would go and supply more if offered a higher wage rate? Thirdly, if you are working to accomplish some financial target, then once you hit the target, you're going to stop working. So if you get a higher wage rate, you might decide that you need to work fewer hours to reach that financial target, and therefore your supply curve will be negatively sloped under those conditions. So let us return to the determinants of the supply of foreign exchange. Those locals who supply foreigners with goods and services, and those who sell domestic assets to foreigners, are the ones who will be supplying the foreign exchange to the local economy, because they will be selling something and earning the foreign currencies. Those selling goods and services will generally influence the supply of exports, and their activity will be captured in the current account of the balance of payments. Those selling assets and investments to foreigners will generally influence the supply of foreign investments, and their activity would be captured in the capital and financial account, which we will often call the capital account. If the supply of these goods, services, or assets is independent of the exchange rate, then our foreign exchange supply curve will be a vertical curve. If an increase in the price of foreign currency will motivate them to supply more, then the foreign exchange supply curve will be positively sloped. So our analysis of the foreign exchange market begins, and we are going to start by identifying the equilibrium price and quantity, the intersection of demand and supply. And in this first analysis, I'm going to use a vertical supply curve, and we are looking at the intersection E star fx0, which I should call Q star. And here we have a positively sloped supply curve. The ideas are pretty much the same in terms of the equilibrium. And I remind you here that you should always choose a country and a currency. By that I mean that you are determining the market for foreign currencies, in which case you say, if I am in Mexico and the foreign currency is US dollars, then this is the Mexican market for US dollars, the demand for US dollars in Mexico, and the supply of US dollars in Mexico. So E would be the price of US dollars from the Mexican perspective, and therefore it would be in pesos, and the quantity of foreign exchange would be the quantity of US dollars. The price is in Mexican currency equivalent, and the quantity is the quantity of the asset, US dollars. Let us get back to the analysis using the vertical foreign exchange supply curve, and we are going to ask the question, what happens when the price of foreign currency is set too low? Again, if we stick with the example that we are in Mexico and this is the price of US dollars in Mexico, we're asking the question, what if the Mexican authorities fix the price of US dollars and they fix it below the price at which demand would be equal to supply? As in the case of any price that is set too low, you would expect there to be a shortage. The demand should exceed the supply, or the quantity demanded should exceed the quantity supplied. The ramifications of a shortage should be analyzed, and we're going to come back to that momentarily. On the other side of E star, let us set the price for foreign currency too high. Again, that the Mexican authorities set the price of US dollars above the equilibrium price E star. We would see here an excess supply or surplus of US dollars appearing in Mexico, not because the quantity is increasing in this case, but because at the higher price, Mexicans would reduce their demand for US dollars because they think it is priced too high, and the supply, which is fx0 or q0 star, will be greater than the quantity that they would demand at E prime, which would be q prime. We're going to examine the consequences of setting the price either too high or too low, but let us use now the positively sloped supply curve and see what that analysis does and how it differs from the vertical supply curve. If the foreign currency price is set too low, for example, the Mexican authorities are underpricing the US dollars in Mexico, then the demand will increase because of the lower price. The quantity supplied, according to the positively sloped supply curve, would decline. So at E bar 0, the quantity supplied is QS0, and the quantity demanded is QD0, and we're talking about excess demand between B and C, so that's the extent of the excess demand or the shortage. And an interesting consequence occurs here. When foreign currency is underpriced and the demand exceeds the supply, there will be frustration because everyone who wants it at that price will not be able to get it. If you wanted something at a particular price and couldn't get it, you might just be willing to pay a higher price to get it. So let us assume that the quantity demanded is twice as high as the quantity supplied. Further, let us assume that twice as many people want foreign exchange as are going to get it. So we're saying if everyone gets equal amounts of foreign currency, then we have twice as many people wanting and only half as many people receiving. Those who don't get access to the foreign currency at that price might be willing to buy it at a higher price from those who did get it. We're saying that the law of demand says at a quantity of Q0S bar, the price that the market will bear is E double prime. So imagine that those who bought it got it at E bar 0, the lower price, and they can now resell it at E double prime because of the fact that there are people who would be willing to pay that price, and they don't care if they get it from the authorities or they get it from those who just bought it. So those who are eager will like to buy it at the lower price and resell it at the higher price, buy low, sell high, and look at the magnitude of the gains they will receive. It's the difference between E bar 0 and E double prime in price. So the amount of revenue they would make is E bar 0 over to B, then up on the vertical plane to the demand curve, and then over to E double prime. That rectangular area would be representing the amount of revenue that would be made by those who managed to purchase it at the lower price and now can resell it at the higher price because the demand for that quantity bears a price of E double prime. So hopefully we understand the consequence of underpricing foreign exchange. It will create that parallel market where individuals will go and purchase it from those who just got access to it, and that will not be in the authorities' best interest because they didn't want that to happen. Why would the authorities sell it at a low price to have other people go and sell it at a higher price? The authorities themselves could have sold it at a higher price, and the government could have kept all of that extra money that somebody else is just going to take now because they managed to get in and purchase the quantity before other people who also wanted it. In economics, this is called rent-seeking behavior when you're looking to buy low and sell high. Let us now move on the other side of the equilibrium E star and set the price above that market clearing price level. So we're going to set the price at E prime. The foreign currency price is set too high. So again, we're in Mexico and we are pricing the US dollar above the price that the equilibrium in the market should support. If we price above the market clearing price, then the demand will go down, the quantity demanded will decline from Fx0 to QD prime, and it is possible that the quantity supplied will increase to QS prime, and if this does happen, we're going to have a surplus of foreign currency, the distance between F and G, or between QS prime and QD prime, and this is what the pricing of foreign currency too high does. It creates a surplus or excess supply of foreign currency. So we have an idea of what the consequences of pricing too high are, and we see that the consequences of pricing too high do not seem to be nearly as deleterious as the consequences of pricing too low. Again, if you think of any other scenario where you might be selling something and you set the price above demand equals supply, and you might be happy with selling less. In fact, I would argue that all of imperfectly competitive economics, which is the majority of economics, operates at a price that's above this mythical E star, where demand is equal to supply. So we can see that for all the imperfectly competitive forms, monopoly, oligopoly, duopoly, etc., we are in exactly the situation where the price might be set too high compared to the equilibrium price, and there are normally not many negative consequences of doing this. Firms in imperfectly competitive markets would actually make this choice on their own to go to a point such as F, because that would ultimately be more in their best interest than a point such as A. We would say that A is in society's best interest, whereas F is in the firm's best interest. So if you understand the ideas of imperfectly competitive markets, you would see why this is not necessarily a bad thing. Of course, we're not saying that the foreign exchange market is imperfectly competitive, because it is one of the most competitive markets out there. But if someone can corner the market, then you can see how they might decide that this is something they want to do, and they want to get a price such that they can maximize some profits. So let's repeat what we said a few minutes ago, that if the price of foreign currency is set too low, the excess demand results in a parallel market, sometimes called an illegal market or a black market. On the other side of the equilibrium, if the foreign currency price is set above market clearing, it will result in a surplus of foreign exchange, and in this case there are not many detrimental consequences for the local economy, especially in the short run. I have a note here that says think China, because if you were to think of countries in the world that set the price of foreign currency too high, China would be the most glaring example. And you have all of this tension between the US and China because China is choosing to set the price of the US dollar higher than it should be if the free market were to determine the price. And we have this political football of the US president and the US authorities telling China it needs to appreciate its currency or let the value of the US dollar fall in China. And hopefully you understand why that is the case. From the Chinese perspective, there's an advantage to pricing above market clearing. What that does, it makes the price of US goods more expensive. A simple translation: if the price of US dollars is expensive, then the price of US goods priced in US dollars would be higher, and this would make those products less attractive to the Chinese, so the demand for imports in China will go down, and analogously, the supply of Chinese products in America will go up, because this is a bilateral rate. So if you viewed it from the US perspective, then the price of US dollars being too expensive means that the price of Chinese currency is too cheap, and if it is cheaper, then a cheaper Chinese currency means cheaper Chinese goods, hence more imports, and you see the US balance of trade issues coming about because we're buying lots of cheap Chinese products because the Chinese have fixed the exchange rate inappropriately. They've priced the US dollar above market clearing prices, which by default means that the Chinese currency is priced below market clearing from the US perspective. Hopefully that gives some insight into the politics of the exchange rate. I would say that most developing countries do not do what China is doing, which is pricing foreign currency too high to help their exports. Now you can understand why the authorities at the International Monetary Fund might tell countries when they price foreign currency too low that they need to devalue their currency, in other words, do what China is doing, because the devaluation in theory, and I say in theory, is supposed to help your exports and hurt imports, and if you can increase your exports and reduce your imports, then you will improve your balance of trade. And for countries that have balance of trade problems, the International Monetary Fund would say to them that they need to let the price of foreign currency rise. If the price of foreign currency is set below the market clearing level, then you can see how the authorities' insistence that the price rise to get to the equilibrium would be, in theory, a good thing. You can at least understand the argument that is being made. Part of the reason that the International Monetary Fund can tell countries to do that is because countries go to the International Monetary Fund when they are in need of balance of payments support. And the International Monetary Fund will say, well, you are creating your own problems, pricing foreign currency too cheaply, and if you would allow the market to determine the price, then that would reduce your imports, increase your exports, and that will solve the problem you have. So either the International Monetary Fund is very smart, or many of the countries that price foreign currency too low are not very smart. In economics, we are supposed to start by assuming that all behavior is rational behavior, so we have to start by saying the countries who underprice foreign currencies are being rational when they do it. We also have to say that China is being rational when it overprices foreign currency. So this raises some interesting analytical issues. How can both of them be right? They have different goals, and we need to investigate what the goals are so that we can come to a more holistic answer as to how this pricing of foreign currency actually affects various economies. Let's now move the analysis so that we can consider shifts in the demand and the supply curves. What causes the supply curve to shift? Well, back to the generic supply curve, there are many factors that determine the quantity supplied, and if you're looking at one of the non-price variables, then a change in any of those variables must be shown by shifting the supply curve, which is the price-quantity relationship, to the left or to the right. So we need to remember what the various determinants of supply are, and that will help us to uncover why the supply curve shifts and how it shifts. In this particular graphical analysis, we have a rightward shift of the supply curve, so that we start at Q star 0, and now we are at Q star 1, a vertical supply curve, and the immediate consequence here is that the equilibrium price of foreign currency will go down. An increase in supply generally causes the price to fall. Let us ask a similar set of questions on the demand side. What causes the demand curve to shift? What are the consequences of a shifting demand curve? In this graphical analysis, we're going to shift the demand curve to the right, and we are saying, if you can recall the generic demand function I started with, you will see that beyond the price of the product or service or asset, there's a host of other things, such as the prices of substitutes and complements, income, advertising, demographic and geographic and climatic variables, etc. So when we come back to the foreign exchange market, there are lots of things that can cause the demand to shift that are not related to the exchange rate explicitly, and we need to come back and talk about what those are. Using a negatively sloped demand and positively sloped supply curve, we can ask the question again, what are the consequences of a shift in the demand curve? In general, a rightward shift of the demand curve, because of one of the non-price variables changing, will yield a higher equilibrium price and a larger equilibrium quantity. So an increase in the demand for foreign currency will raise the equilibrium price of foreign currency. We will generally call this an appreciation of the foreign currency, which is a depreciation of the domestic currency. It is possible that the demand curve might shift and the authorities might not let the price rise as a consequence. In fact, what happens in many developing countries is because they don't want the exchange rate to move around too much, they don't want it to respond on a daily basis to the forces of demand and supply. So again, you should think through under what conditions would you be selling a product and you don't want the price to fluctuate too much. Think of the products whose prices fluctuate on a daily basis, and you might think of gasoline, and because there's so many potential sources of gasoline, we probably don't think too much about it, and the owner of the gas station probably says others are going to raise their price because they have to, therefore I have to raise my price. However, residents in a particular country don't have other options available to them when the exchange rates are changing, so they're stuck with having to purchase this particular asset at a higher price if the demand curve shifts to the right. So the question is, why do the authorities like to fix the exchange rate and not let it respond to market forces? There are two main sources of demand, as we said earlier. It's the demand for imports, or the trade-related demand, and then there's the demand for financial assets, foreign currency financial assets. Because the latter is a far more variable phenomenon than the former, we have a situation where individuals might change their demand for foreign assets very quickly, and this is generally a flight from domestic currency to foreign currency, and once this starts, it is pretty hard to stop. It is particularly more deleterious if you have foreign investors in your country and they see the price of foreign currency moving in a direction that's against their interest, and they start moving their monies abroad, certainly back to their home country. Locals in that country, think Mexico, might also decide, hey, if the foreign investors are moving their monies for a better return, we're going to try and move our monies as well. And then there's a scramble for foreign exchange that might be earned from selling stuff, and it's all going out seeking a safer haven because no one wants the price of the domestic currency they're holding to fall. If they see the price of the foreign currency is likely to rise, then you want to buy low and sell high, so the sooner you can buy that foreign currency and either just hold it, whether you hold it at home or you move the monies to a foreign account, you just want to get your monies out of local currency and into the thing you think is going to rise in price or appreciate. And that flight from local currency to foreign currency creates an unstable exchange rate. It certainly pushes the exchange rate, the price of foreign currency, higher, and it could have a snowballing effect. Once this starts, the authorities have a hard time stopping it. Perhaps I should call it a spiraling effect. And the authorities try to hold the price down to prevent it from rising too far and too fast. You might think of this as having some kind of outdoor canopy, and the winds are starting to blow, and you're trying to nail this thing down because you know that once the wind gets under it, the whole thing is going to fall apart. It's going to be blown down, so you're trying your best to hold it in place against the elements. Well, that's exactly what's going on in many countries. They're trying to hold the foreign exchange rate at a certain level, hoping that the increased demand for foreign currency, which is a speculative demand or flight to a safer haven, would subside and things would come back to more normalcy, and the exchange rate at which they're pegging or holding the foreign currency can come back to be the appropriate operative rate. You can understand then with my wind under the canopy analogy how this might be something the authorities are trying to maintain against the tide. There are only so many storms you can withstand, and if the winds blow harder, it's going to cost you more energy to keep that thing in place. And that's what happens when there's a loss of faith in the local currency and everyone wants a flight to the safer currency. Then you will see the authorities losing the battle to maintain the exchange rate at E star bar, and the market forces will push the exchange rate up to the new equilibrium, or even higher. In fact, there's a theory called exchange rate overshooting, which will say that the exchange rate will overshoot its long-run value. So instead of going up to the intersection of D1 and S0, the exchange rate may actually go higher. This is not hard to understand, especially when we think of how the oil prices rose to $147 in the summer of 2008, and it was not because the demand for oil was increasing and the supply was decreasing. In fact, the reality was exactly the opposite. The demand was lower and the supply was higher, and oil prices just skyrocketed to $147. It was because of speculative behavior on the part of financial institutions. So if you can understand how that happened, you can see how this happens in the foreign exchange market as well, an even more competitive market than the oil market. So here's the same situation with a positively sloped supply curve. Obviously, the consequences on the equilibrium price are not nearly as deleterious as with the vertical supply curve, but the qualitative effects are the same. When we spoke about the balance of payments, we mentioned it as balance of payments accounting, and the key word there was accounting. So in accounting, there's this desire to have everything balanced. Balance and accounting are the key words, I should say. And the balance of payments is just a summary of all of the transactions between one country and the rest of the world. And we're saying that at the end of the day, the balance of payments is equal to zero in accounting terms. But in economic terms, it's possible that the balance of payments, which is the sum of the current account and the financial and capital account, can be positive or negative, especially when there's a fixed exchange rate. The equation at the top of the screen says that the current account increases positively with the exchange rate. So if we are in Mexico and the price of US dollars is rising, then the demand for US imports goes down. The supply of products to the US from Mexico goes up because Mexican products are cheaper in America. So the depreciation of the peso, which is an increase in price of the US currency, would improve the Mexican current account. That's what the CA parentheses E says, that the current account is positively correlated with the movement in the exchange rate, meaning the price of foreign currency. On the far side of the equation, we have FA parentheses I minus I star. I is the domestic interest rate, I star is the foreign interest rate, so I minus I star is the gap between local and foreign interest rates, and we say that if the gap between local and foreign interest rates increases, then that should cause more money to come into the local economy, so more foreigners will invest in your country if you offer a better interest rate, all things remaining equal, and therefore the financial and capital account will positively correlate with the interest rate difference. The graph you see here is for the current account analysis, demand for imports, supply of exports, both of which depend on the exchange rate. And when we aggregate them together, exports minus imports, the sum gives us a positive correlation with the exchange rate. So here is a picture showing the negatively sloped demand for imports, a function of the exchange rate, and a positively sloped supply for exports, and we have the equilibrium. Now what we're going to do is to add the financial and capital account activity here to see what it does to the old equilibrium. Let us assume that there is foreign investment into the country, That increased supply of foreign currency will shift the foreign currency supply to the right, and notice the new intersection will be a lower E, E1 star, and a larger quantity as we expect, Q1 star. So when the financial accounts are added, we can see that inflows will cause the price of foreign currency to go down, as you would expect. An increased supply of anything should cause the price of that thing to go down, and we're going to have a lower price for foreign currency, which is an appreciation of the local currency. A rightward shift of the supply yields a decline in the price of foreign currency. That summary gives you a sense as to how the balance of payments relates to the foreign exchange market, and this is the economics of what is basically an accounting analysis balance of payments.